The final objective of this chapter is objective 5 about disposal of portfolio bills or financial instruments. How we record the necessary journal entries for the sale or disposal of portfolio bills or financial instruments. The disposal of equity participations and blocked securities is similar to the disposal of fixed assets not subject to depreciation because equity participations and blocked securities are for long-term investments, so they are treated as the sale of fixed assets who are not subject to depreciation. However, placement securities are treated in a different way. We will see how we record the sale of placement securities. So we have to differentiate between the disposal of equity participation and block security together and the disposal of placement securities. Regarding equity participation and the blocked securities, the disposal of these type of securities is similar, as we said, to the disposal of non-depreciable fixed assets. Here we have two entries to record. The first entry by the acquisition price of participations, we debit account 681 like we did in fixed assets not subject to depreciation. So we debit 681 net book value of fixed assets disposed of for equity participations, and we credit account 251 for equity participation, which is a balance sheet account. Here we are decreasing, or we are setting off out of our books the equity participations we disposed of. The second entry is by the sale price of equity participations. So we have to debit 53 account or 512 or 46, which are related to cash or bank accounts or accounts receivables, and we credit 781 revenues from fixed assets disposal related to equity participations. So usually when we have a sale for equity or blocked securities, we record two entries as we have seen in these two journal entries. Regarding the sale or disposal of placement securities, the evaluation is done by one of the following methods. We have to calculate the cost of these securities based on the simple weighted average cost method or the first in first out method FIFO. Regarding the simple weighted average cost, as we see in this example, if we have a portfolio of this company, of Jade company, which includes securities from ABC, according to these details, 900 securities for $2,000, 600 for 300, and 500 securities for 2,500 each. Assuming the company sold 1,100 securities for $2,400 each. How we calculate the weighted average price? It equals the amount of all securities over their quantity. So to 900 times 2,000 plus 600 times 2,300 plus 500 securities times 2,500 over total quantity of securities, which are 2,000 securities. We got a weighted average price of $2,215. So the cost of this of the quantity sold would be, we sold 1,100 securities times the weighted average cost we calculated. We got $2,436,500 as a cost of quantity sold. The revenue from sale would be 1,100 times the sale price, which is 2,400 is given. This is the sale price given. So we got a total sale or revenue $2,640,000. So we have a result of profit of $203,500 as a net profit from this sale. If we are using the FIFO method, first in first out, the first quantity of the security purchased would be 900 out of the 1100. Then we take the 2 from the second set purchase. So we have 900 times $2,000 got 1,800,000. The second 200 to reach the total of 1,100 securities were purchased at a cost $2,300. We got a value of 460,000. So the total amount would be $2,260,000. So the cost of the quantity sold equals to 2,260,000. The revenue from sale is 2,640,000. So here the profit is $380,000. So whenever we have a result of a profit from the sale of placement securities, we have to record two journal entries. We debit account 7781, net income on sales or disposal of placement securities. We mean by that marketable securities, and we credit 50 account related to placement securities. This is the entry by the acquisition cost of securities. The second entry is by the sale price of securities. Here we debit either cash or bank accounts or accounts receivables, and we credit 7781 same account, which is net income on sale or disposal of placement securities. As you can see, we are moving the same account one time as a debit and the second time as a credit, which is 7781, which is a net income or revenue account because the result is a profit. If the result is a loss, as you can see here in red color, we have two entries also. We are moving the same account, but here we are moving an expense account, not a revenue account. So we debit 676 account, net charges on sale or disposal of placement securities, and we credit placement securities account, which is account 50. And the second entry, we are debiting cash or bank or accounts receivables, and we credit the same account 676 net charges on sale or disposal of placement securities. So the first entry is by the acquisition cost, and the second entry by the sale price of securities. Let's see a practical example. We have ABC company received a statement from its broker on the stock market related to deeds that the company delegated them to sell. Based on the statement, the following schedule were prepared. We have N shares, 200 N shares, purchase price at $1,200. The sale price is set at $1,250, and the provisions constituted were $20,000. For our debentures, we have a quantity of 300 shares. The purchase price per unit $1,000, sales price per unit $900, and the provision constituted previously $15,000. Knowing that the company listed partial account for shares and another for debenture loan, the company didn't receive from its broker the sale price rate. We have to record all journal entries. So the first entry is to record actually the purchase. So I debit because the result, as you can see here and the given, because the result actually is a profit, I record a debit 7781 net income on sale on disposal of placement securities, and I credit 502 account placement securities for $240. Regarding also the other types of placement securities, I recorded the loss. For the second type, for debentures, I debit 676 net charges on sale or disposal of placement securities, and I credited 506 placement securities by the amount of 300,000, which is 300 times 1,000 shares. Regarding the sale entry, I debit accounts receivables in account 469 for the total amount of 520, and I credit for 250 the net income on sale on disposal of placement securities by the sale amount, and I credit 676 account net charges on sale or disposal for placement securities by $270,000. For the provisions, I do a provision write back for the two amounts of provisions recorded for the $20,000 plus $15,000. So I debit 59 for provision for diminution in value of placement securities, and I credit 779 for a provision write back of total $35,000. Let's see this more comprehensive problem about disposal of placement securities. We have on 31/12/2022 the evaluation of portfolio bills of Alpha Company showed this information. Purchase dates on year 2022. On 24/2022 we have securities X, quantity 100, purchase price $2,200, and market price $2,050. On 7/5/2022 we have also securities X at a different quantity, different price 2000. Also market price was the same 250. And on 8/9/2022 we have different security Y of quantity 200, purchase price $1,000, market price 800. On 31/12/2023 the market price of the shares was for X $1,800 each, and for Y $1,200 each. On January 2024 the company sold 120 securities X for $2,120 each by check referred to the bank. We have to prepare journal entries on 31/12/2022, journal entries on 2023, and to prepare the disposal journal entry on January 2024 without considering the constituted provision for the sold deeds awaiting the inventory on 31/12/2024. So here is a given is assuming that we don't need to take into consideration any previous provision recorded. We just record the disposal entry. Starting by calculating the average price on 31/12/2022 for securities X, we have 100 purchase at 2,200 plus 150 purchased at $2,000 over the total number of securities. We got an weighted average cost of $2,080. So the decrease in value would be for security X 2,080, which is the cost, minus 250, which is actually the market. We got a $7,500. The decrease in value for securities Y would be of $40,000. So we have a total decrease of $47,500. The entry to the record provision, we debit 679 account amortization and provision on financial charges, and we credit provision for diminution in value of placement securities. On the following year we have also to manage a provision. The decrease in value for security X would be $70,000. However, the previous year provision was $7,500, so we have to increase the provision by $62,500. So we record the same entry. We debit we debit amortization and the provision on financial charges, and we credit provision for diminution in value by, as you can see, $62,500. And regarding security Y, since we have no decrease, so we need no provision, so we cancel the previous provision, which was $40,000. So we have to debit 59 account, as you can see. We debit 59 provision for diminution and value of placement securities, and we credit financial provision write back by $40,000. Regarding year 2024, since we purchase cost of sold securities 120 by $2,080, and revenue from selling is 120 times $2,120 equal to 254. So here we are calculating the result from the sale. We got a profit result by 4,800. It is very important to know the result of the sale, if it is a profit or loss, to know what are the accounting entries to record. Since the result is a profit, so we are using the account 7781 net profit on sales disposal of placement securities. So we debit 7781, we credit 50 account by the acquisition cost of the securities, which is 249,600. Then we debit bank and we credit the same account but by the sale price of securities, 254,400, which is the amount of sale. This is actually was everything related to chapter 5 regarding financial instruments and portfolio bills. Thank you.